Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Carnival stock has actually had a really nice recovery over the past year. The company's bookings are up. It's starting to cross that barrier to operating cash flow positive. And there are definitely some bright signs ahead for the company, but there are four major red flags that make this an uninvestable stock right now. So I want to get into exactly what those are and why they're such a big problem. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. Now, any discussion about risks or red flags for Carnival has to start with the company's debt. So that's what I'm going to start with today. This is a look at the company's balance sheet. And the platform that I'm using to look this up is called Koifin. If you're interested in doing research like this yourself, I've got a link to this in the show notes. It gives a nice discount. But I'm going to show the graph of what has happened to long-term debt over time. You can see here that long-term debt has gone from under $10 billion before the pandemic to over $30 billion today. That is just a massive number. As a result, the company's risk profile really changes. When you have debt, that comes with interest payments. I'll get to that in a second, but it's not the same as having, let's say, a market cap of $32 billion. Comes with requirements. You either have to pay it back or you end up filing for bankruptcy. Now, I'm not predicting that's what's going to happen with Carnival, but it's very different having an enterprise value that is heavily weighted towards debt or an enterprise value that's heavily weighted towards equity. One of the things that I think is fascinating looking at Carnival is that if you go back to before the pandemic, the company's enterprise value was right around $45 billion. Today, that enterprise value is nearly $50 billion. So the company as a whole is worth more today than it was before the pandemic. Operations are worse, which I'm going to cover in a second. And the company has more of that enterprise value associated with debt, and that's high interest rate debt as well. So that's just a massive red flag for the company. Without executing flawlessly and getting to the point where they can pay back that debt or lower interest rates on future refinancing, I think this is a massive risk for Carnival. If we go back to the income statement, you can see here that on a trailing 12-month basis, all these are trailing 12-month numbers, operating income is also negative. So on an operating basis, the company is not making money. Now, if we look at quarterly results, you can see that Carnival did swing to a positive quarterly profit on an operating perspective of $120 million in the most recent quarter. So that's been a pretty rapid improvement, but that is going to have to increase dramatically just to be able to pay off the company's debt. So the second red flag that I really want to hammer home is that operating income is negative, and this is for a company that needs to have positive cash and profitability from operations to be a viable company long term. My third red flag, and this is the thing that I think is going to be a major headwind for Carnival, is increasing costs. These left columns right here are the operating expenses for the 3 months ended May 31st. And the ones that I think are really concerning are payroll, commissions, food. Fuel is something that has actually been down recently, but is likely to go up because oil prices are rising. And then selling and administrative costs are rising really rapidly as well. One of the major costs associated with Carnival is paying staff, having people actually on ships, running the ships, cleaning rooms, preparing meals, all of that kind of stuff. The cost associated with that kind of labor is going up, and we're seeing it in these operating income numbers. You can see that the expense for operations has gone up sharply in the past year. Now, this is partially because there have been more voyages, so passenger ticket revenue is going up, but this is absolutely going to be a headwind. The final thing that is a red flag to me, and I'm going to stay on this statement right here, is interest expense. $542 million in interest expense just for the most recent quarter. That is rising because interest rates are going up, and you can see it's nowhere near being covered by operating income. So not only do you have a massive amount of debt, you're not even making enough from operations to be able to pay the interest on that debt. That is a massive red flag for a company like Carnival. Now, like I said, there have been some positives for Carnival over the past year. Bookings are up, cash flow is improving, operating expenses are improving, but this is a company that's nowhere near a sustainable point for operations long term. And like I mentioned earlier, the enterprise value of Carnival is actually higher than it was before the pandemic. So if there is a blip in the company's operations, if we go into a recession, if consumer spending starts to fall, we could really see Carnival stock pull back dramatically. And that debt level is going to be a massive burden for the company. That's why I think this is just a stock to stay away from. I know that it has been a bet on the recovery of the economy and certain parts of the travel industry, but there's just much more risk with a company like Carnival than there is with a lot of other companies. But what do you think? Do you disagree? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.